Hi, I'm Josh. This is Frankie. We're the Peck Brothers. We're going to show you today the secret on how to create never-ending cash flow. We promise you that you will never look at cash flow the same ever again. Now, if you have any of these things right here, stocks, mutual funds, CDs, bonds, annuities, money market, even real estate, you want to pay attention today because you're making a huge mistake if your goal is to create a cash flow. Now, banks, they discovered this years and years ago. What we're going to show you today is nothing new. This is something that we're just going to reveal that banks have been doing forever, years and years and years.
So basically what it is, these are the secrets that the banks have used for all this time to be able to show you how to create this cash flow. So what do the banks do? The banks will typically use real estate to be able to create this cash flow. So for example, they're not out there buying the real estate. They do own some buildings. We're not saying the banks don't do any of these things, but the banks, if you want to become truly successful, the largest corporations in the world are the banks, and what do? They don't do any of these. They might have some money into stocks, into options, and this and that. They might own a couple buildings down in New York or wherever they own the buildings in Chicago. But what they don't do is they don't buy homes and they don't rent them out to people. Why? Because it creates...
The banks aren't running out buying real estate and throwing up a for rent sign, saying, hey, I want some cash flow. They're not doing that. So why are you doing that?
So what we're going to teach you how to do is we're going to teach you how to lend like the banks do. We're going to teach you how to use this piece of real estate as collateral just like the banks do. So when you're out there saying, hey, what am I going to do? How am I going to create this cash flow? Would you rather be collecting money from renters or owners? Who's more likely to pay you? Who's more likely to be less problems? Who's more likely to work with you and trying to get your money? Because renters have nothing vested in this property. It's the owners that do. And that's what the banks realize. The banks realize owners, people that rent, the people that buy these properties are the ones that care. And they're the ones that are going to pay you when times get tough. So what we're going to teach you how to do is we're going to teach you what the banks do. The banks, they'll lend on these properties. They're on title. They use these properties as collateral. And what happens is they feel safe when they're lending the properties at 80% loan to value. What that means is if the property's worth $1 million, the most they'll lend is $800,000 because that's 80%. Now what we do for safety, we do 50 to 65% loan to value. Max 65, but on the average about 55%. What that means is there's 45% equity to protect your money.
I think to reiterate that too, the banks, remember, they do this all day, every day, right? You can get approved for an 80% loan, and that's what they're going to do. We're talking to you about lending at a 50 to 65% max loan to value.
So what happens is that you go on title, you're safe with that money because the house is there, and if you don't get your money back, guess what happens? That person gets foreclosed on. The owners will lose their money in that property. And guess what they don't want to have happen? They don't want to lose that money. So they work tirelessly to get your money before you foreclose on that property. This has happened to us with our clients hundreds and hundreds of times. Very, very rarely do we have foreclosure, but it does happen sometimes. Now the key to this whole thing is managed trust deeds. Are you having to do it? Are you having to go look for the foreclosure procedures in each state? Are you having to see if it's a judicial versus non-judicial? No. We work with the company. We've been doing this for 13 years, and they take care of everything for you. Everything is managed. If there's a foreclosure, they take care of it. They take care of all the problems for you. They take care of all the headaches for you. All you do is create a never-ending cash flow for you. It's a mailbox investment. You just go and pick up your check out of the mailbox, and you sit down and go, what am I going to do today?
So this is how it works. So for instance, you have the banks over here that when you want a piece of real estate, or if somebody wants a piece of real estate, they're going to use that real estate as collateral to get that loan. And the banks are going to loan on, if it's worth $100,000, they're going to loan up to $80,000. But what happens after the person borrows the money? Well, they have a payment that they make every single month. And what is that payment? That's cash flow to the bank. Now, here is the beauty on being able to have all the benefits of investing in real estate. You have the collateral, right? That's what people understand. Nobody's just going to walk away with a house. You can't do that, right? It's there. It's something that's not going to go anywhere. So that's why the banks absolutely love this, is because they loan on it, and in return, they get cash flow every single month. So the banks actually advertise this. They send you stuff in the mail. Every time you come in, hey, would you like a loan? They want to loan you money. Why? It's because they know that they can ask you for real estate or whatever you have to basically collateralize it. They know that they're safe at the 80% loan to value. So here you have these big banks, or even if a small bank, they're going to loan out on a piece of real estate, and in return, they're getting cash flow. That's how it works. They're getting cash flow. Now here's the thing.
I think you're giving up too much secret, Josh.
A little too much secret. So here's the secret. The thing is does the bank care on that you had if you borrowed the money from the bank, right? Do they care that you had a leaky pipe last month? Or do they care that you broke a window?
Remember the house in Mississippi? How the whirlpool tub went out $3,000 later?
Tell them.
You own a property in Mississippi, Whirlpool manager calls and says, hey, Whirlpool tub went out. What do we got to do? Well, let's just put a cheaper tub in. No, we replace the Whirlpool tub. $3,000 later.
So
waste of money.
the whole purpose that we even had the Mississippi property, we do things together. The whole purpose we even had that Mississippi property is the dream of having cash flow. But with that dream came nightmares. I mean, absolute nightmares. Yeah, when we got the check, when it was actually rented, when we got the check and we weren't signing over a check that was even more than what we were getting for rent, those months were nice. But at the end of the day, I mean, our rate of return was so little with all the nightmares, it was just absolutely crazy. So the thing is, you take the bank here, they're loaning out and they're getting cash flow. They're getting that rate of return. So you take the bank out of the equation and we'll put you there. So here's the bank. When you go in and the bank loans you that money, are they just spitting on their hand and they're saying, hey, we got a deal? No. They put a lien against your property, right? It's a lien against the property. So whoever's borrowing the money can't just walk away. They can't run out and sell it. So the question is this. Is the bank safe? Do they feel they're safe and they loan all day, every day at 80% loan to value? Do they feel that if someone stopped paying them, that they could go and they could take the house back, they could sell it and get their money back? Well, yeah, they do it. They're the masters at cash flow and safety. And so the thing is you took the bank out of the equation, we put you there, but now we're only at a 50, 65% loan to value. And guess what? As it's managed for you and your money goes into a property, essentially what you're doing is you're lending out. And now you have that cash flow. Somebody's collecting it for you. They're doing the deal. I mean, it's a legitimate loan, right? There's title, there's escrow. It's a legitimate loan.
Right, and you brought up the safety aspect of it, Josh. So the Department of Real Estate, a couple years back, was trying to educate people on investing in the trust deeds. And really what you're doing is, I could say you're investing, but you're really lending. You're just becoming a lender. You're becoming what the banks do. So what they did is they put, remember Josh, that pamphlet that came out?
Yeah.
And they said what to know about investing in trust deeds. And in it said, almost everybody that invests in trust deeds gets their money back. It just depends on how much equity you have. Because you have to be able to foreclose on a property. There's got to be enough money there to foreclose and pay for attorney's fees to be able to do those things. So this is why having a cushion there, having all that equity there is protection for you. Because safety is the most important thing when you're trying to earn a rate of return on your money. Not earning set 30% rate of return, and all of a sudden, as John Bogle says,
who's John Bogle?
John Bogle owns Vanguard, one of the largest mutual fund companies in the world. Right now in the United States, there's almost $19 trillion in mutual funds. And John Bogle owns Vanguard, which has $5 trillion under management. That was in 2018 going into 2019. And he says that in any given year, that market can cut 50%. It's happened 3 times to him. And he says it feels like it's like a nightmare. It's like it's never going to come back again. He says if you're in your 20s and 30s and you can afford to write it out,
so
go ahead and do so.
If you're a youngster, okay, throw money into mutual funds and stuff.
But if you're close to retirement and you don't have time to write out a 50% drop, because in order to write out a 50% drop, you got to earn how much?
100%.
You got to earn 100%.
So if you lose 50, you have to gain 100 just to break even.
$100,000 to $50,000. Now you have $50,000 to earn 100% to get back to 100,000.
Right. And how long does it take to make 100%?
It takes forever. And we've seen the average is taking anywhere between 7 to 10 years when your money just to break even again. And can you afford to lose that time? Can you afford? I mean, how much can you sleep at night? Can you live the same kind of retirement if your money drops by 50% at some point? That's a tough way to be in retirement. This is why using real estate, not as purchasing and renting, but lending on real estate to owners, will protect your money and be able to earn you a cash flow. Right now, our trustees are earning a 7% rate of return with the real estate collateral. Have you ever heard of anything like that? People always tell us, what do they always tell us when we meet with them?
Is this legal? Number one.
Yeah.
Number two, this is too good to be true. Or everybody would be doing it. Or like, everybody is doing it. You know, you loan the money to the banks over here and they're turning around and they're doing it.
But it's never been allowed for people like us, the regular person, to do it. Because usually, it's banks doing it or hedge funds, institutional. They'll come out with these hundreds of millions of dollars and they'll lend out on this stuff because they know they can earn a good rate of return with the safety involved. So it's never, ever, ever been allowed for the average person to be involved with this. The average person with a $500,000, $1 million 401k or an IRA. Well, now you don't have to put your money at risk because this is all we know. Now you don't have to have stocks and mutual funds waiting for that 50% cut one day. You don't have to have CDs and bonds and annuities that don't pay anything. That really, if you're lucky, if you outperform inflation, right? Inflation is a silent killer.
If you're lucky.
You're lucky. And then money market accounts don't do anything at all. But real estate, I mean, that's always a good investment. There are people, that's good. But
and there is a cash flow.
At what end of it do you want to be on?
At what cost?
At what cost? Do you want to lend? Or do you want to sit there and collect rent? from people, and then have a chance of it being empty, and then some company got you into Florida and these little tiny properties, and all of a sudden, you don't have real estate anymore because it's empty and it's gone. You're losing it because you got a loan on it. It's how tough is that, especially when you're a long distance owner?
Yeah, that's right. And so you look at this. The safety is here. You have the income. Now you look at the 7% return right now. The 7%. So you can go and borrow right now, these days at the bank at a really, right now the rates are decent, right? A pretty good rate. So your thing is how am I earning a 7% on loaning money out with real estate backing it up for 50 to 65% loan to value? I'll tell you my story real quick, okay? So I had a home that I could purchase, that I had an opportunity to purchase, and it was about 50% loan to value. I mean, it was a fixer-upper, but it was a killer deal. My thought was, I'm going to go buy it. So what do? I had another property that had a ton of equity in it. So I ran down to the bank. It was U.S. Bank. And I said, U.S. Bank, and I had just finished a loan with them. I said, I want to buy this property over here. They looked at it and they're like, yeah, whoa, what a steal. That looks really good. So yeah, no problem. We'll loan you the money. Here, fill out this paperwork. 30 to 45 days, you'll have your money. I had to have my money that week, okay?
And you're self-employed.
Yeah, and I'm self-employed, so it's a lot harder to get approved for a loan. Yep. So what did I do? Well, I went and got private money. So I had a piece of property with a ton of equity in it. I put it up as collateral. I borrowed at 9%. Somebody might think, why would you borrow at 9%? Well, I just told you why. If I didn't have money by the end of that week, then I was going to lose out on that opportunity. I mean, hundreds of thousands of dollars in equity that I could walk into. So did I care about paying a 9%? No. So is the person that loaned me money safe? Well, here's the question. Is the bank safe when they have collateral, when they loan? Well, yeah, they're loaning 80%. Are we safer if we're loaning at 50 to 65? So here's my story. I borrowed that money. I bought that house. I fixed it up. I had 1 year to pay it off. I had 1 year to pay off a 9% loan. This is private money. So what did I do? I fixed it up. Now I had time. I went back to U.S. Bank. I got an appraisal. I did my paperwork. And then I chopped my rate more than half. But then guess what? That private money that I borrowed, I turned around and I paid it off immediately. Quick. The person who loaned me that money, well, they made a really good rate of return. Were they safe? Yeah. Did I have to make monthly payments? Yes. Cash flow to the person who loaned me that money. Did they care what color I painted the house? Did they care what kind of flowers I planted in the yard? Did they lose sleep over any of that? No. All they cared about was that mailbox check. I sent a check in the mail. I actually had to send a check, right? I sent a check in the mail. They walked out to their mailbox and they pulled out their cash flow. And it was never ending until they go into a new deal, okay?
So if you're the kind of person that has any of these kind of investments, that you're worried about the market turning around, that you're getting ready for retirement, you're in retirement, if you're within 10 years of retirement or in retirement, is this the kind of stuff that you want? Do you want stocks and mutual funds? Do you want to be worried about it? One of our other clients said, hey, my other friend says, I made a little bit more money than you this year. And he goes, but you know what? He looked at my friend and said, at least I could sleep at night. I don't have to worry about getting my check. I don't have to worry about it. There's problems that you're going to have to worry about when the market drops or cuts in half. And so at the end of the day, who is the winner in the end of the day? It's the guy who feels a lot more comfortable and sleeps better. You don't have to worry about any of this stuff. This stuff is not how banks make their money. This stuff is how we've always been taught. This is all we know. But there are other things out there. There are other ways to protect your money. Okay, so John Bogle says this. He talks about the stocks. He says, is mutual funds as safe as stock? Are mutual funds safe? He says it's as safe as the stock market. He says, which is to say, to be quite blunt, it's not safe on any short-term basis.
Wait, this is the guy that owns the largest
mutual fund company in the world,
right? Over $5 trillion in management. And he said, what about where most of you have a big chunk of your money? It might be an IRA or 401k. By the way, you can put IRA or qualified money into these trustees. And he said, what about?
He says it's safe as stocks, mutual funds.
So the question is are stocks safe?
And he says no. He says basically it's not. Especially on a short-term basis. On a long-term, yes. Okay, so he also says this. He says it's really time to be thinking about how much risk that we want to have. And he says, and we need to be making some defensive moves. Even before this quarter's extreme stock volatility, he said he's never seen so much volatility in his 66-year career. This was at the end of 2018. This is before the market's even jumping up and down. So anyways, Vanguard is $5 trillion under management. And the question is, what do you want to do with your money? Do you want to protect your money with real estate? Do you want to collateralize your investment? Do you want to earn a really good rate of return? Oh, the other thing people always say is it's too good to be true.
Too good to be true. I didn't bring that.
And I met you. I wish I would have met you 20 years ago.
I wish I had met you 20 years ago. And we actually say that. Here's what people say. Is this real? Are people really doing that? It's too good to be true. And I wish I would have met you 10 years ago, 20 years ago, 30 years ago. We've even got like 40 or 50 years ago, right? We weren't even alive then.
So there's some power in not having your money go backwards.
So I think one thing that we kind of brushed over real quick is that when you loan money on these properties at a very safe loan to value, you actually go on as a lien holder on that property. Your name or your IRA's name or the name of your trust or the name of your business, you go on. So if something were to happen to us, right, knock on wood, you are on title on that property, or you are a lien against the title of that property. That's where this huge safety comes in. It's very transparent, a generous rate of return. This creates monthly cash flow like you've never seen before. Now, we're not spending principal. If you're over here and you're spending money, now you know exactly how much you have on a monthly basis to put in. And as you continue to save, you can continue to open up new trust deeds. So when you put money into to trust deeds, managed trust deeds, a lot of times you go into different properties. So there's where the diversification comes in.
That's true. And so this is the thing. The thing is this, people can earn a tiny bit more money by doing it themselves. But we also have one of our clients, one of the top realtors in all of Hawaii. She basically says, hey, I'm doing this with another company. I'm earning a little bit more money than you guys. I said, well, one, where are you investing in the properties?
The laws are different in every state.
What state are you in? You know, I said, two, and who's managing it for you? What's going to happen if you have to foreclose or if you have to collect a payment? And she goes, oh, don't worry about all that. It's all being taken care of. Well, finally one day she says, biggest mistake of her life. Because she invested in a property outside of a state they have to go to a judge. She had to go find an attorney. She had to go try to foreclose. And then she ended up with this property that really wasn't worth the value that she thought it was. So we basically, and not only do we do appraisals on this property with the company we work with, but they also do their own internal appraisals to verify that the values are really worth what they say they're worth. Yeah. So you need to find out, if you want to get a free analysis and find out how this works for you, how these work in your numbers, in your scenario, then you need to click the link below.
Click link below, and we promise you'll never look at cash flow the same again.
Click link below for never, ever ending cash flow.